So what we're going to cover this afternoon, we're first going to talk about a recap from the first half of this year. We're going to talk about what we think is in store for the second half, some of the investment trends that we're seeing, and finally, we're going to wrap up with our thoughts on where we think things are going, what to make of all the data and exciting news coming out, and what it all means. So first things first, and people have probably been a little more engaged than normal to the news cycle here, so these might not be new topics, but we saw a plethora of things through the first half this year. We saw tariff negotiations, which are continuing, inflation. We saw multiple instances of geopolitical tensions and wars breaking out between Israel and Iran, as well as between Israel and Hamas. Federal Reserve and where they're looking at as far as interest rates and potential cuts going forward, in addition to the recently released Big Beautiful Bill. And then lastly, the US debt. So overall, the stock market came in this year off of the back of a pretty darn strong year last year, with the S&P 500 finishing up over 23%. Earnings growth through 2023 and 24 were tremendous, coming off of 2022, which was not such a wonderful year. And we had a bunch of tailwinds coming into this year. President Donald Trump started his term in January, quickly got to work on the agenda and policies that he had spoken about on the campaign trail and potentially implementing them. One of the promises throughout the campaign was balanced global trade and the talk of tariffs and how we potentially might have been being treated unfairly by other countries. This, along with the yearning to cut the U.S.'s substantial debt, have been top economic talking points. You hear it over and over. And we do see with this big bill that there is the potential that the debt could expand. The hopes are that the efficiencies and productivity brought to the U.S. will outweigh that and that the debt will not continue to grow as rapidly. On April 2nd, President Trump announced the Liberation Day tariffs, which would essentially be reciprocal tariffs to those charged to the U.S. rather, by other countries. Many of you probably remember the big board that was shown with all the different tariff rates. And it is safe to say that after that moment in time, chaos kind of ensued. Up to that point, the S&P 500 was trading just about 3.5% lower on the year. In the following 4 trading days after the announcement, the index lost over 10% as investors worried about growth and what was to come. The Dow Jones, had double-digit losses during that time, as well as the Nasdaq. It was a pretty violent drawdown in a very, very quick period of time. In addition, it caused many companies to suspend their earnings guidance as there were too many uncertainties brought by tariffs and would not allow them necessarily to forecast accurately. This was very interesting as we hadn't seen this since the COVID era, essentially, where companies kind of suspended giving guidance and forward-looking statements because they were hesitant, didn't know what the future held. So we saw collectively from many companies, this was the same trend. And fortunately, things have continued to move forward. Here's a quick chart. And I know, although it looks like a blip there, which in the grand scheme, hopefully at the end of the day, any correction or drawdown does look like a blip and things hopefully continue to move up and to the right. It did feel scary as it was happening. There was a lot of uncertainty. And it seems as though, in our opinion, what we saw was a lot of global investors selling. So it was almost the perfect storm. And for those of you who we've spoken to prior to this, you've probably heard us say something to the extent where, as of end of December, a very, very large portion of U.S. investments was owned by international investors. And during that time period where the initial, kind of talks of unleashing these tariffs was put out, I believe what we saw was international investors, whether it be individuals or companies or, sovereign wealth funds, pull money out of U.S. markets, both in stocks and bonds. So stocks dropped, interest rates ended up moving higher, and it really was the perfect storm. On April 9th, the White House announced a 90-day pause on the reciprocal tariffs that they imposed just a week prior. This reprieve was set in order to help the U.S. and their trading counterparts come to an agreement on trade practices going forward. Some also say that, based on the fact that the bond yields moved as aggressively to the upside as they did, that this move was kind of forced in order to keep things moving orderly and keep the quote unquote plumbing moving smoothly as far as markets are concerned. At this point, investors have mostly shrugged off trade fears, and it's very interesting. Again, the news cycle has moved very, very fast. And this is kind of reminiscent to 2018, 2019, where at the end of 2018, you saw interest rates were moving higher at that point in time. Tariff negotiations were kind of hitting a stalemate, and talks were intensifying. And in the back half of the fourth quarter, things drew down very dramatically. Through 2019, although the tariff talk and negotiations did continue and the tariff talk intensified in certain cases, you actually saw markets and investors kind of shrug things off, and we ended up finishing up the year in excess of 25% on the S&P 500. In economic news, the Federal Reserve has held rates steady through 2025, much to President Trump's dismay. The latest inflation reading for May came in line with expectations at 2.4%. Core inflation rate year over year for May beat expectations of 2.9% as it remained lower at 2.8 for the third straight month. Fed Chair Jerome Powell has been insistent that while inflation is coming down, it's not yet at their 2% goal, and for that reason, they remain steadfast in their rate. Expectations right now are for just a couple of potential rate cuts this year. Truth be told, I wouldn't be terribly shocked if we had one or none. The economic data overall is holding up quite well from what we can see. Inflation is cooling, so that does bring about the argument that rates should be brought down. However, again, the employment market as well as the economic, in sense all around the world are staying very, very strong. So with that, it provides a pretty strong argument as reason not to continue to lower rates. As far as earnings are concerned, we've seen tech continue to drive the push forward here. And in my mind, it makes sense. We don't necessarily look at technology companies at this point in time as the most crazy, risky sector that you might have, 10 to 20 years ago. Tech, in my mind, kind of almost is like the industrial or the backbone of our nation here and of the world. And companies across the board, no matter what sector they're in, are leaning towards using technology. They're starting to make change and implementing AI, which we'll get to in a bit. And yeah, I mean, it's been incredible. So what this chart is showing you is the difference between the Mag 7, the Magnificent Seven names that you all know about, Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla. And their earnings have far outpaced, all other 493 names in the S&P 500 over time, and we think that will probably continue. The stock market has been resilient in the face of many uncertainties throughout 2025. All three major indices are currently up for the year and is at all-time highs at the end of the second quarter. So here we are as of market close June 30th of this year. The Dow Jones has notched a 3.6% gain, the NASDAQ at 5.5, and the S&P at 5.5. Things are right around there, depending on the day, slightly higher. And again, very interesting that we had that drawdown. And since then, we've seen an appetite by investors to own stocks. Interest rates haven't budged too much, but we have continued to see the move in equities higher after that drawdown there in April. All right, Ant is going to take it away.
All right, this is kind of what we're focused on for the second half of this year. There's about 6 different topics here that I think will dictate where markets are heading and where the economy is heading as well. So as of late, a few days ago, President Trump announced that he will be putting out a deadline of August 1st, where the initial deadline was in July. But it seemed back in July, it was a little bit more lenient, where he was in hopes that talks of trade deals will get done before then, but said that it wasn't a mandatory stop date. But it seems as of late that August 1st date is stamped down, and he does not seem to want to push that any further. it just seems that he wants to get these deals done, and he wants to put the pressure on all of these other countries to make some deals and even out the playing field. Tons of countries, at least 22 nations, uh, are facing rate hikes of at least 25%, and the bigger countries of upwards of 50. So I'm curious to see how things shake out over the next few weeks, and if it does bring more trade deals to the table. Um, so we'll see what happens there. We got a close eye on that. The Fed has also been pretty stagnant on cutting rates, as Gabe said earlier. It just seems that because of all of this tariff uncertainty, the Fed chair is a little cautious to cut rates a little too soon, especially with the economy and earnings growth through the stock market doing so well. It hasn't given him a real opportunity to really push that button and cut rates where it doesn't seem fully necessary yet. So, like Gabe said, I am not anticipating major rate cuts here. Maybe one, if not zero. But again, I'm curious to see what happens towards the second half of this year. And the same thing with the U.S. debt ceiling. So they had to raise it by 5 trillion from 36.2 to 41.2. It is one of the largest in U.S. history. It does bring some fiscal concerns and economic impact, but it was necessary to keep things moving along. I think that there are some actions that are going to be taking place to kind of bring all of this together, but it just felt necessary at the time. Again, yeah, tariffs looming over corporate and earning projections. I think that just has to come with uncertainty. Certain companies out there do not love uncertainty, and it kind of gives them a lack of sense of direction. So that's a little bit of what we're looking at, but it does seem, since the pauses and the potential trade deals being put out there, that companies have really shrugged it off and shown significant and strong earnings so far this year, and that again was backed a lot by tech. Um, it just seems that they keep on growing, they keep on putting money back into the business and trying to innovate. And as long as earnings growth continues, I see some continued growth in the market. So I'm very optimistic that that will continue, and I think that that's a huge part with AI as well. All of these technology companies are implementing artificial intelligence into their businesses and trying to pass that along into all different sectors of the market to make their businesses run more efficiently. And I do not think that that's going away. I know it is new and somewhat scary, but it is a powerful tool and could be used for great efficiency for not only our economy but the world economy. So I'm looking forward to see how more data comes out and how much more uh, technology is being used surrounded by AI. And lastly, yeah, will stocks reach all-time highs? I think that that's focused on earnings growth. As long as that continues, I think that we are set up for a lot of positive news ahead of us. There's been so much negative news in the beginning of this year. I think that we should be positioned for positive news to come out, and that coupled with earnings growth should be a great thing. And yeah, what we're seeing here is just a graph here of a historical Fed funds rate and what the forecast is. It was currently it is at 4.25 to 4.5. With that potential rate cut, we are forecasting it to come down. So we could see it come down as under 4 and potentially to 3.75 here. So we'll see what the Fed says at the end of this month's meeting. Another graph and forecast of the Fed's fund rate, also with inflation. So you've seen that inflation is starting to come down. The Fed's fund rate has been hovering around pretty stagnant, but we do forecast at the second half of this year and into next year things to start coming down. So as more data comes out, we will certainly keep you updated. And just it's important to stay the course and know that there are always going to be times of market volatility, and it could be very, very hard for individual investors to not feel emotion during times of panic and uncertainty. But it's truly important to know that, owning great companies and holding on to them and not just collecting profits when things are up and then you see things get a little bit hairy here. Um, it tends to hurt people when they try to time the market. The power of compounding interest, of staying in the market, is a beautiful thing and a very powerful tool. And you'll see that in the next slide of an example of one who panics during the market and times it, and someone who stays in the market. And here it is right now. So someone with a hypothetical return uh, of around 10%, which is what the S&P does. Someone who has 100,000 and has stayed in the market for 25 years. You'll see that on the right-hand side. Has been through the ups and downs and dealt with the volatility. You see that the compounding interest over time has led to 662,000 and change. Whereas someone who has tried to time the market and has maybe sold during times of uncertainty, and during times of uncertainty and markets going down, there always is a recovery. And if you miss just only the 10 best days through that time period of 25 years, your account balance is cut in half compared to someone who stayed in. So it is truly important to ride those waves and know that you have great companies and they are very resilient and they will bounce back. And just staying diversified is important. These are just the many examples of times where there was market corrections and the recoveries and how long it took to recover. And you see time and time again, dating all the way back to the 50s up until as recent as this year. Um, there have been sharp declines, but it seems, especially with the technology and news outlets coming out today, the recovery is very V-shaped, so very quick to the downside. But the moment positive news comes out, it shoots right back up. So maintaining diversification and holding on is certainly in your best interest. Thank you.
Awesome. Thank you very much, Ann. And just to wrap up before we get to questions here, again, we think by far and large, we're going to see earnings strength continue throughout this year. We'll see over the next roughly, 4 to 6 weeks how earnings for Q2 play out. And we do anticipate that we're going to see some great numbers, particularly in the technology and communication services sectors. Economic growth remains strong. We anticipate that this should hang in there as well. A lot of conversations that we do have with folks in different businesses have made pivots, and where that initial shock factor that took place in April has kind of become subdued, pardon me. And, they, again, have made pivots, have made change, and are now charging forward to their next goals. Trade and tariffs in the U.S. first economy. I will be honest. I think that again, we don't even necessarily know. We had formed a deal supposedly with China a couple of weeks back, which was announced very briefly. We don't necessarily know the outcome of that, or if there will be follow through. But the fact that China is off of the talking points and headlines, I think, is a big thing for investor confidence. We just saw the announcement on Monday of 25% tariffs on Japan and South Korea, among other countries. And we saw the tariffs late yesterday at a 50% rate on Brazil. And markets really, again, kind of just shrugged it off. So we could see something very similar to what we looked at, again, at the end of 2018 and 2019, where although tariffs might be implemented and might escalate, you could see markets kind of become used to it. Investors continue their appetite for stocks and things move higher overall. As far as the geopolitical outlook is concerned, I think we're all hoping for peace. That's been a very interesting situation, and things do seem in the immediate to have calmed down quite a bit. And then the big theme overarching, which I think kind of outweighs everything at this point, is this race for AI. And whether it's technology companies spending hundreds and hundreds of billions, if not trillions collectively on the race to create the best products out there, or the 10 other sectors in the S&P 500 utilizing artificial intelligence in their day-to-day to make their companies more efficient and more profitable. In addition to foreign investment coming into the United States to have access to some of what I would consider the greatest companies in the world. I think that's going to be a really, really tremendous trend, and I think that's also going to help propel things higher. So with that, we would like to open it up to questions. Stop sharing the screen here. And yeah, please ask away. Oh, and I see our first one here. Question: has the market priced in a Fed rate cut? I don't believe so. Interest rates really haven't nudged down too much yet. I think there's just, this hype around hopefully the continued earnings growth that we've had, particularly through 2024 and beginning of 25, that things have been very strong, and the actual numbers have beat expectations in multiple instances. So I think that's kind of the animal spirit pushing things a bit higher right now. And I definitely think that if we do have actual rate cuts materialize, which whether it's this year or maybe they become more prevalent next year, that's a whole other reason to continue to boost the markets. Great question. What is the year-end S&P forecast consensus on the street at this point? So that's interesting. A lot of people revise their predictions here in April. They were brought down significantly, and I think what we're looking at, kind of in that middle range here, is anywhere from roughly 5,800 on the low end to about 6,400 on the high end. I personally still remain optimistic, and I think you're going to see the S&P propel higher than 6,400. So I would place ourselves here at Rockline on the higher end of that spectrum. And again, in my opinion, higher than 6,400. I just think there's so much transformation going on, and you don't really see it reflect in the numbers until earnings are released. But the trend is undeniable, and it's accelerating. There's a snowball effect here, and it's picking up and gaining steam. And I think we're still in the very early innings. Any other questions? No? All right. Well, we thank you all. Thank you all for joining us. If anybody has questions, that they don't want to discuss here in the open forum, obviously, please feel free to contact us. And the biggest thing we want to say is thank you all, everybody that we work with. Thank you for your trust and confidence. And cheers to hopefully a wonderful second half year. And we look forward to speaking with you and seeing you. And have a wonderful, wonderful summer.